Welcome to the December 4th, 2023 Advance Report for McGowan Group clients and NetWorthRadio.com listeners. This is the Santa Claus Rally, and that's why this thumbnail today said Santa Claus Rally. This is a big spike right here. That's the Dow for 5 years. Santa Claus arrived on Thursday with the Dow up 520 points. I'm going to give you some of the interweavings of what's happening here as we go into 2024, but that was a nice spike. Corporate profits up about 5% over the past year and projected to go up 22% over the next 2 years. We'll see if those predictions are actually true, but it is driving equity values. And the other factor is interest rates and the Fed. So how do these two things interplay? By the way, I'm Spencer McGowan, your financial weatherman with your weekly fast-paced tour of the global financial markets. I'm president, McGowan Group Wealth Management, a dynamic and friendly team of 10, the team that cares. We serve affluent families right here from the Crescent in Dallas. You can set your own Zoom call by going to NetWorthRadio.com, or you could come in for a tour if you like. Now we're going to go to the interest rates. Look at this. This is the 10-year Treasury. Run in circles, scream and shout, right? This yield goes from a fraction of a percent all the way back up to 5%. That sent shockwaves through the markets in September and October. Now that yield has started back down, 4.3% instead of the 5% where it peaked. Now those shock waves that went through the market, the reverse effect is the happiness that you see in an equity market celebration, because net present value of future cash flows go down when your comparison rate, either cash rates or the guaranteed rate, when that rate goes up, the value of future cash flow goes down because you got to use the discount over the time. Same thing happens in reverse. If rates go down because inflation in October was 0 for the month, then what you start to see is those values come back up, especially if earnings are rising. That's the real story for 2024. A lot of the major banks, Deutsche Bank, Bank of America, UBS, all saying that the Federal Reserve is likely, before the end of the first half of the year, to start bringing the massive increases in the Fed funds rate that pressured the markets. They start to bring that down. And Jerome Powell, all year, jawboned the equity markets from going up by saying, oh, I'm going to go up even higher, even higher. Inflation's still too high. And that caused people to be more anxious, if you will. Now you're reversing that. There's another impact, and I'm going to cover a global high yield success story. Remember, it's not a recommendation for your portfolio till you get a written plan from McGowan Group Wealth Management, which is pretty easy to do. We have $1 million minimum, and anything that or more, we're happy to give you a written plan for what we would do, and it's exactly what I would do with my capital too. Anyway, capital back in 1993. This is the best 30-year fixed income track record in the bond market that I've been able to find out of all of them. A guy comes in my office back in 1992, and he was a wholesaler, and he said, I got a guy in from London, and he is a chief strategist, and he needs to tell you about Brady Bonds. Now, these were bonds created in the bailout of the money center banks for the money that they had loaned to Latin American countries. They solved the crisis, and out popped something called Brady Bonds. So it's emerging market global high yield bonds, basically. Anyway, we had a great year in '92. Then Mexico hit the skids, and we've learned to trade more effectively along that 30 years. But during that 30 years, this is the detriment of the Fed tightening cycle. And that tends to work in reverse, like here's 2018 tightening. So when they stop torturing the markets, you tend to get a fill back in values. What's the result? If you reinvested dividends for that 30 years, that is total return of nearly 1,500%, 9.44%, average return even after the detriment of the tightening cycle. And with the gain potential in global high yield, these bonds are discounted about 75 cents on the dollar. Current yield is about 10%. Federal Reserve, if they bring the rates back down, highly likely you go back closer to par, so you get big interest and you get a potential gain. Wow, that could turn out really well. And that's part of the portfolio, along with energy infrastructure and rising medical dividends. This is Dallas. So North Texas home price is represented by S&P Case-Shiller Home Price Index. So where are we? Nationally, home prices hit a record up about 4% over the past year. Dallas has started to rise, but we're still 2.5% below the peak frenzy of 22 when there were bidding wars everywhere, and that's not happening as much with high mortgage rates. And people are still coming to North Texas, so that's starting to come back up. What is it compared to 3 years ago? Go back to December 2020 after the pandemic. This index was 212, then it goes to 302. This is a 40% gain in the average home price in North Texas for the past 3 years. So congratulations, equity owners. That's about the result that most people can expect depending on location and other factors. So good news for Dallas. Whoa, this is bad news. Okay. I just want to give a warning sign, and I got to go back to the 2020 time period. What happened here? This is the pandemic, right? This is the Global Clean Tech Energy ETF, low-cost ETF fund. And boom, I mean, this was the future. We were going to go net zero. Everybody's excited about the clean technology. Well, it's a little harder to make a profit making electric vehicles. Pretty much the only one in the United States doing it is Elon Musk at Tesla. And companies like Lucid and Rivian now running out of money. Lucid lost 220,000 vehicles they sold in the third quarter. And there's a realization that this is a lot harder than people thought right back there. $14 billion has come out of this space. And it is an absolute disaster this year in the pricing of the clean tech companies. I think there'll be some bargains in there, but this is an absolute run for the exits, and it's a story about investors getting way excited, obviously too excited, and then ending up in a house of pain. So be careful on your entry points. This is a warning about value at risk of loss. Even when something looks so good, you just can't stand not having it. Sometimes it's good to take a deep breath or to call McGowan Group and say, hey, what do you think? I'm Spencer McGowan. Thanks for tuning in. We'll be back next week. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the Longer Play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.